to share. I will share in a second after I greet you properly. And so let's see who's in here. Let me hit this button here. Justin Pender, good to see you. Good to see you. Justin, you were there last night for Prime Class. Those of you that want to join us in Prime Class, that's where we focus on generating income from selling stock options. So you can actually go to drboyceprime.com to take a look. El Hodge, good to see you. Let's see, Shauna. Thank you, Shauna. It's good to see you as well. Shauna is from our support team, and she is there to answer any questions you may have. El Hodge says Prime was good last night. Well, thank you, El Hodge, for saying that. I appreciate that. And let's see, Mr. Jan Jasmine, Otis McDonald, good to see you. Good morning to you too. It's so good to see you, and I respect and appreciate your dedication to understanding investing and becoming better investors. I think this is going to really serve you well long term, and I want to do my best to help you in your journey and help you to get where you want to get to. So give me 1 second here, and I'm going to share some things with you. Let me do one little thing here. Okay, so here's the first thing I wanted to kind of tell you guys. There most of the research that I'm doing and most of the indicators that I'm looking at are predicting that next year is going to be a good year for the stock market. I was looking at some research today and some data. I was a little bit concerned because there are some risk factors in the market right now. There are some issues to be concerned about. But some data I just saw basically said that usually when the Fed stops their rate hiking cycles, the year after that, the market tends to do better. And if you know that 2022, we had a lot of economic pain because the Fed was just hiking interest rates constantly, trying to get inflation under control. And now that cycle is done for the most part. The odds of them continuing to heighten interest rates going forward are extremely low. Now, the thing about the Fed, though, is that the Fed has made some mistakes, and there are some that are concerned that they could make another mistake, which could be costly. But for the most part, I think we're looking pretty good for going into next year. So this will be a good time to be patient. Again, nothing's guaranteed, but based on most of the indicators that I'm seeing, it's pretty much saying that we're looking pretty good right now. And so I'm going to actually give you some stats and data on this that might help you to sort of make a decision. And also, I'm going to give you, there's a stock that I like that I'm invested in, and I'll share that with you. Give me one second here. Let me see here. All right. So one other thing I wanted to mention too is since it's Black Friday, I know some of you were looking for stock market investing tips for beginners to kind of get started. I assume most of you are invested in the stock market. If you're not, I encourage you to go and get started. I think that will be a great gift to give yourself as we go into the holidays and a great gift for your family. And I would also encourage you to get your children gifts that are going to last them, in a meaningful way, not just some silly toys they're going to throw away in a few months. And so one thing that you can go take a look at if you're interested is there's something I'd created called the Dr. Boyce Method. And the Dr. Boyce Method, the drboycemethod.com. It's a Black stock market weekend that I did that was really popular. Everybody really liked it. And it was basically a simple 11-step process. Now, they say you should have only 5 or 7 steps or something like that. But I put 11 in there because I really wanted to make it simple. So if you're looking to get started to go deeper in your investing or to level up your investing or to get insights into a process and a procedure in terms of 11 questions you can ask yourself about an investment before you make it, feel free to go to thedrboycemethod.com. I think the regular price is $299. Right now it's $68. So you can feel free to go and grab that and also share that with your kids. Share that with your spouse, share that with your baby mama, baby daddy, share it with anybody who will learn, because in the Black Business School, we just want everybody to learn. And we're super proud. We have 162,000 students in the Black Business School now on YouTube and various platforms. We've achieved about 500 million views. We have over 1 million downloads on Spotify. So we're building Black-owned media also. And we made a really great movie called B1 the Movie. We still haven't had a chance to really release it fully yet. Rick Mathis has been doing screenings around the country, but the movie's really good. We just haven't had time to really put it out there because there's so many things that we want to do in terms of building the Black Financial Therapy Department. We've been working on that. Also, we're going to Africa next year. You guys know that. So that's our big trip for next year. I think that trip's pretty much sold out, though, to be honest with you. But if that trip goes well, then we'll do other trips. But I think there's maybe a couple more slots. And so inside the chat, Shauna, I don't know if you have the link to that. I think it's b1voyages.com. The number one voyages with a V, voyages.com. So feel free to go to b1voyages.com if you want to go with us to Africa. All right, so let's talk about some notes from the market, and then also don't let me forget. Actually, you know what? I'll give you the stock in a second. I want everybody to get a chance to get in here, so then we can talk about it then. All right, so here's a few notes in terms of some of this data on 2024 and why experts believe the market's going to do well in 2024. Number one, basically that because inflation has started to cool off, the Federal Reserve is expected not to increase interest rates. That's a big deal. The Fed has been hiking interest rates like crazy. That's what's been kind of weighing down stocks. Now that they're not going to hike rates anymore, there should be a jump from that. But then also what's probably expected is that the economy will slow down. This is going to sound crazy, but part of the reason they also believe your stocks are going to do well next year is because they believe the economy is going to not do so well. So what's going to happen is that the economy is going to sink a little bit. The unemployment rate's going to go up. All your friends who are not investing are going to say, oh my God, the economy is so bad right now, but you're going to be quiet. And the reason you're going to be quiet is that there's a very high probability that your stocks are going to start going up. And this is because the stock market does not react to what the economy is doing right now. The stock market reacts to what it expects the economy to do in the future. So that expected recession and all that's going to happen in 2024, you've already endured that. You've actually already gone through the recession. Investors kind of live in the future. So effectively, what will happen then, and this is based on the fact that America tends to take care of rich people, is they're going to actually the Federal Reserve is actually going to reduce interest rates when they start to see the economy having its problems. Well, guess what happens when the Fed reduces interest rates? What happens to your stocks? Y'all can guess that in the chat. Yeah, because you're an investor, you're going to actually benefit from the Fed reducing interest rates. So while the rest of the world is saying, oh my God, the economy's so bad, the jobs are not available, it's terrible out here, you're going to have to be quiet at the dinner table because you're going to be looking at your Robinhood account or your stash account or your Acorns account or your E-Trade account or your TD Ameritrade account, and you're going to be seeing green, most likely. Not to say this for sure, but this is what a lot of experts are predicting. So give me a guess if you follow that very awkward logic. The stock market's a very strange, peculiar place, and it does weird things. Okay, so by the way, good morning, Kendall Green and his family. Kendall and Karen, I met y'all at the convention. I enjoyed meeting Kendall and Karen. Now, the stock that I liked this week is Savers Value Village, and the ticker symbol is SVV. That's Sierra Victor. Savers Value Village. That's the stock that I bought. This is not invested advice. There's no guarantees. But that's the stock that I purchased. Now, if you wanted to look this stock up, I think today, I don't know. Let me see what it's doing. I know that overall the market kind of went down a little bit today, which is a buying opportunity. When it goes down, that's good news. When it goes up, it's good news. So if you look up SVV, Savers Value Village, let's do a quick analysis on this stock. Okay, this stock actually went up a little bit today. Let's see here. It's down a little bit this month. It's down a lot in the last 3 months, 50%. So a lot of experts believe this stock has a lot of upside. They sell secondhand merchandise in retail stores, and its stores are located in the U.S., Canada, and Australia. Let's see, founded by Mark T. Walsh, 22,000 employees, a relatively small company. Its market cap is $2 billion, which that's crazy that's small, but that still is a small business. But a lot of analysts seem to like it, and the research that I saw said that Savers Value Village has some upside potentially, and perhaps it's because the stock has taken such a hit. Again, one stock will not save your life. One stock is not going to change everything, but Savers Value Village was one of the stocks that we listed. Now, if you go to drboycestocks.com, that's drboycestocks.com, you can see the stocks list I give my students every week. And in fact, I'm going to actually give you guys another list in a couple of days. So, but Savers Value Village is one of the stocks that's on that list. What else is going on with the economy that you should know about? Let's see here. The probability of the Federal Reserve raising its policy rate beyond 5.25% has dropped significantly. Historical data shows that the S&P 500 generally performs positively in the year that rate hiking cycles conclude, or that they stop hiking rates. I'm reading here. There's a growing trend of delaying expectations for rate cuts, with the majority now expecting it in the third quarter of 2024 instead of the second quarter. What does that mean? Well, that means that there are people that expect the Federal Reserve to do the opposite of what it's been doing for the past couple of years, which is they expect the rate cuts to occur, but they used to expect them to occur earlier in the year. Now they're saying it should happen toward the end of 2024. That's when the rate cuts are expected. And if it's a surprise rate cut, or the minute they announce the rate cut, that's when you're going to start seeing the stock market react the way that that you're hoping that it will react. Investors are advised to stay invested based on historical performance. So stay invested, maybe increase your holdings, especially when you have, some rough days like this. Or, well, today's not really a rough day. Today's kind of like the end of a series of amazingly good days. In fact, let me show you all. Has anybody, give me a yes in the chat? I'm hoping, I pray to white Jesus, black Jesus, and baby Jesus every single day, that Black people, that all of us, B1 people, intelligent Black people, are committed to what I call economic awareness, or financial consciousness. What's financial consciousness, or what does it mean to be financially woke? Being financially woke, to me, means that you're paying attention to what's happening in the economic world. Like, you're not just letting it fly by you and over your head or whatever. You're looking, right? So let me ask y'all this. Give me some yeses, and it'll really make my day. Have you guys been following what's been going on with the NASDAQ 100? Has anybody been following what's been going on with this market the last 10 days? Has anybody? Give me a yes. Please say yes. Please say yes. And if your answer is no, then you don't have to say no now. Just document that. I want you to be able to say yes to me, because this has been amazing. Let me show you some examples. Let me show you why it's been amazing. Okay. Let me just kind of screen share so you can kind of see what I've been seeing and why this is just so beautiful. It makes a grown man cry. So let's look at Apple stock. Apple stock doesn't even really move that much, but look at Apple stock over the last 5 days. Y'all see that? Look at Apple stock over the last month. Y'all see that? Can y'all see that on the screen? 9.73%, almost a 10% increase over the last month. Year to date, 51% rise in one of the strongest companies in America. 51%. So your money grew by 51%. Again, if you for years just been taking the extra money that maybe you might spend on fast food, and the same amount, matching that amount by putting it into things like Apple stock, your money grows. You're making money without working. That's one of the ways people make money without working. Let's look at Meta. Let's see how Zuckerberg's wealth is doing. So Meta, not so good today. Today's a down day. Last 5 days, last month. Look at Meta the last month, 7.11%. Last 6 months, year to date. Look at that, 160. Can y'all see that? Give me a yes. You're seeing that on the screen. I want to make sure, because I'm switching screens. I want to make sure everybody can see when I'm typing this in. Do you see this? Do you see Meta going up? Look, I mean, that's insanity. Insanity. Imagine if you had a house and your house value went up 169% in 1 year. How happy would you be if that were to occur? Look at that. That's insane. If you go over the course of the year, Meta stock has doubled. So you're making money with Zuckerberg, right? So I think that, if we're aiming for a goal, maybe one of the goals is that we can invest in stocks as much as we invest in other areas like real estate, right? Because clearly, and this isn't just something that just happened. I mean, this is a long-term trend. If I go back 5 years, look at 5 years ago with Meta stock, right? You had this major dip right here, a great buying opportunity. It peaked here in 2021, so it went really high. It dipped significantly between then and 2021, or between now and 2021. Now it's on its way back up. So what happens in many cases, the big mistake a lot of investors make is, and this is a mistake that B1 people don't make, because y'all are the canaries in the mine. You are the smartest, brightest people in the room. You're the ones who understand things other people don't. Everyone should be learning from B1 people. B1 people don't do this, but here's what the rest of the world does. they're buying into meta stock like crazy around here when it's way up here, because this is when all the hype and the frenzy's maxed out. This is when the whole world's excited about stock market investing. Everybody's going crazy. The stock market, right? Because it's in the news, it's in the headlines, everybody's talking about it. So they buy, and they do the exact opposite of what a finance professor would tell them to do. Money makers tell you to buy low and sell, right? What? Finish the sentence for me. Buy low, sell blank. Buy low, sell high, right? But what people tend to do, because people follow the crowd, this is real. 70% of all people follow the crowd, even if the crowd is wrong. They follow the crowd because they don't know what to do. So they assume that if I just do what everyone else is doing, that's what I should be doing. That's the right thing. And in the financial world, in the capitalist society, that does not work, because rich people, they lean on that, right? The capitalists that run the country lean on the idea that sheep will follow sheep, even if all the sheep in front of him are getting their heads chopped off. So the sheep, and this is real stuff, they've written real research papers about this. Remember, my dissertation was on investor psychology. Professor David Hirschleifer, you probably can't spell his name, but if you tried it on Google and looked him up, you'll find that David Hirschleifer, who was on my dissertation committee, is one of the world's leading experts on investor psychology and has written extensive amounts of work on herding, on investor herding. So one thing that investors do is they herd. They tend to buy when everything's super hot, super exciting, and then everything starts crashing and dipping and dipping and dipping and dipping. And some people, B1 people, are smart. Y'all buy the dips, because you've been listening to me, and I've been telling you since the beginning of time that there's no time where the market has crashed and never recovered. So you're buying this dip. You're buying Facebook when it's $90 a share. Why? Well, because this is where you're making your money. This is the big payback. This is the big payback. And I bet you, let's look up another company. Let's look up Microsoft. Let's see if Microsoft has a similar pattern. All right, so let's see what's going on with Microsoft stock. Okay, today, not so good. Last 5 days, they've had a lot of drama with OpenAI. That's been insanity. I mentioned to you guys Friday, I said Microsoft looks like a good buy to me, because I felt that the OpenAI drama was going to go away and the stock price is going to recover. It looked like it did, right? You had a little dip because you had some drama there, and then another dip because even more drama happened. Then things got better. Let's look at the last month for Microsoft. Look at that. Look at that. You're on board with one of the strongest companies in America. Microsoft prints money. Microsoft will never forget how to make money. Microsoft can adjust to any economic condition. They can adjust to any problem. They have problem solvers, so they will always find out how to make money. Look at the last 6 months, 15%, year to date, 55%. Go back a year, you're talking about an increase of, what is that, 53% over the last year. Let's look at the last 5 years. Let's see. So you had a dip, not as dramatic as Facebook, but you did have this peak here in 2021. You had the dip. B1 people, you're buying the dip. This is the big payback. This is where you're making your money. Let's look at another big tech company. Let's look at Tesla. Tesla's very exciting. So let's go to Tesla here. Tesla, another S&P 500 company. Everybody is speaking consistently about the demise of Elon Musk, how it's only a matter of moments before this man goes down. For whatever reason, he has not gone down yet, and he continues to keep on ticking. Last 5 days of Tesla, a little bit, about 1%. The last month, 13%, last 6 months, 27%, year to date, 123%. So far this year, amidst all the people saying that Elon Musk is terrible and he's going down any second now and his whole world is falling apart, this man is winning because his stock price went up by 123%. If you go over a course of a year, 43%. Last 5 years, 1,011%. So you started buying Tesla back then. You're buying it for $15, $13, $14. Now Tesla's at $241 because apparently Elon Musk and his team are absolute geniuses. You still, similar to Facebook, you had this peak here. You had everybody getting excited, a lot of irrational exuberance occurring here. When the stock price is at 407, it drops down to 120, 113. Who has the guts to keep holding and buying more stock when you were buying at 400 and it's down to 113? Very few people have that. Very few people have those guts. Very few people have the ability to pick an investing strategy and be consistent with it over at least 5 years. But here's what happens, just like with Facebook, just like with Meta, just like with Microsoft, you're buying here and you get the big payback. It's not as smooth as it was with Facebook, but it's still a pretty big payback. Now you're at 241, you were buying at 113, now you're happy, you're making money. right? And I can keep going. There are other stocks I can show you, but recently, basically the last couple of weeks, the stock market's been going crazy. As I was talking to you guys last night in the Prime program, I was explaining that I don't think this is going to last forever, and this is the time to protect your portfolio. So when it's doing really well, that's when you sort of put in your stop gaps to protect yourself. So you maybe do that with stop loss orders, where basically you say maybe you unload some of the stock if it drops below a certain price, or maybe you shed some off and diversify, spread your money out. Maybe you get some put options to protect your position, whatever it is you want to do. But either or if you're selling calls, you sell some call options, get some income off the top, whatever it is. But this is the time where you go ahead and prepare, because as as they say in Game of Thrones, winter is coming. Winter is always coming in the stock market. I don't care how good things get. There's always going to be a day where things are going to get worse, and you're going to have to be able to sort of bear that. If you can't stay in the rain, then you can't get to the good times. Sunny days, everybody loves them, but tell me, baby, can you stand the rain? Shout out to New Edition. All right, so let me tell y'all another little interesting thing that I just want just to kind of get you excited, blow your mind a little bit. Maybe it won't blow your mind, but I'm going to try. Let's do a little math right now. Let's talk about generational wealth. Let's talk about generational wealth and what happens if you make the decision today to have the discipline to break a generational curse. So let's do some math and let's figure this out. What if you had the discipline, you chose today to have the discipline to get on your app and set your app to put $50 a week into the S&P 500. Now, you guys know we have the $5 a day investing plan in the Black Business School. This is similar to $5 a day, except it's $50 a week, so it's more like $7 a day. 7 times 7 is $49, right? So imagine if you were putting $50 a day into your stock portfolio. How much money would you have if you were invested in the S&P 500? Let's say you pick something like SPY, Sierra Papa Yankee, VOO, Victor Oscar Oscar, or even AIQ, which is a great AI fund that I really like. How much money would you and your family have in 20 years? You don't have to guess. I'm going to tell you. It would be 100. If you assume a 10% ROI, which is reasonable for the S&P 500, you would have $148,908 in assets and wealth. At that point, you're no longer poor. At that point, you're no longer living paycheck to paycheck. At that point, you're no longer in the struggle. At that point, you're probably in the top 10% of Americans, or 20% at least, in terms of your access to liquid cash. Now, a lot of people have a net worth that might exceed 148,908 if you throw in things like home equity and all that. Right? That's why the house is the key source of wealth for so many people, because basically when you're paying your house note, you're basically just doing the $5 a day plan. You're pouring money in a bucket and you're not messing it up. You're not touching it. That's the key. You're not overthinking it. You're not trying to sell your house every other week. You're not trying to constantly make these moves. You're just paying your mortgage every month on autopilot. See, it's the automatic actions that determine how wealthy you're going to be. It's what you do every week, every month, every day, whatever, that determines where you're going to end up financially. Just like weight, if I have bad eating habits every day, I'm going to get fat. If I exercise every day, I'm going to lose weight, right? So what are you doing every day or every week that's going to build your wealth? Well, this is something very basic, and you can set it on autopilot. So if you have that discipline and made the decision today to say, I'm going to set on auto deposit $50 a week into this fund. Think of it like you can think of it like I did with my child support. I love my daughter, but I ain't gonna lie, I hated paying child support. I'm not gonna lie. I'm sorry. I don't mind taking care of my kids. I love taking care of my kids, but child support's hard because it feels like taxation without representation. You're writing these checks and you can't control where the money goes. And when I got that first job making $100,000 a year, the child support immediately jumped up to a really high number. So you know what I did to pay that 18 years of child support is I said, you know what? I don't even want to have to write that check. Just take it out of my paycheck. That way I'll just work with whatever money's left over. And that's what I did. And I just paid it consistently. So here's the thing. So I'm asking you to basically pay child support for your future. I want you to give birth to a better reality for your family. I want you to give birth to generational possibilities. I want you to give birth to your family generational wealth. And to do that, I need you to pay that $50 a week in child support. And I'm asking you to do it the same way I did my child support. Just automatically deposit that money into an S&P 500 account and don't look at it for 20 years. Or look at it, but don't touch it. Don't sell a single thing for 20 years. And then what happens after 20 years, especially if you got a newborn baby or a newborn grandchild or whatever, or a 10-year-old child or whatever. In 20 years, you got $150,000 in liquid wealth that they have, which does more for them than money can buy, right? It doesn't just give them access to cash. It gives them the ability to live their best life and to be free of things like student loan debt, the curse of the corporate plantation. No stressful decisions have to be made over money. They're able to, your daughter can pick a man because she likes him, not because he's got a good job. There are so many freedoms that are afforded to you when you actually have an endowment and you have a capital base that you can actually lean on. So you're making that initial sacrifice to build the capital base. Every great company in America, every wealthy family in America, from the Rothschilds on down, had to have somebody somewhere in some generation willing to sacrifice to build the initial capital base. Every family, every corporation, every organization, every wealthy entity. So the question for you is, are you going to be that playmaker for your family? Are you going to be that person who just breaks the generational curse, busts out of those chains and makes that change? You can do it. The reason I know you can do it is because I told my mama I wanted to be that guy for our family. When I was 17 years old, I told my mama I was real excited because I got this job. But it was like the first job, and I was super pumped up. And for some reason, I was feeling inspired. And I told her on a payphone, this is how long ago it was. I was on a payphone. I wasn't on a cell phone. And I said, Mama, I said, you know how you have every family has that one person who just takes the family to another level? And she said, yeah. I said, Mama, I want to be that person for our family. And that's what I said to her. I kid you not. And so really, I want you to be that person for your family. Okay, so take this home, show this video to your family if you want. But like I said, that $50 a week in an S&P 500 fund will get you that 150, but it's going to take time. You have to pour in the time. So don't waste your time. All right, so that's it. So what I'm going to do is answer some of your questions, put them in the Q&A section. And by the way, so the stock that I like is Savers Value Village. That's SVV. So that was the stock that I mentioned earlier for those of you that just came in. Let me find okay, so Rarick is asking, can you explain what are stock futures and explain how it affects the market? Okay, so woo, good question, Rarick. All right. I'm taking a breath because I'm like, woo, how do you explain futures in a simple way? All right, so here's what goes on with a futures contract. Okay. Financial markets exist because people have needs and they have things that they want to fix in their lives. They want to either take on more risk or eliminate their risk. So remember when we talked about stock options, or maybe you don't remember, but let me just describe what a stock option is. It's just like an option. Or an option in life. You all know what it means to have options, right? An option is something you could do if you want to, but you don't have to do it, right? Like I have options. I could date that girl or that girl, or I could take this job or that job, right? So we know what it's like to have options, and we know that options have value, right? We'd rather have a life with options than to have a life without options, correct? Got it? All right. So an option is the right to do something, but you're not obligated to do it. That's it. That's pretty much what happens, right? Well, a future is just like an option. It's like a sibling to an option. The only difference is that where with an option, you have the right to do something, but not the obligation. With a futures contract, you have to do it. You have to do it. You have pre-committed to doing it. So you might say, well, why would somebody do that? Why would somebody commit to doing something in the future, when they could just not make a commitment at all? Well, because basically there are people that want to exchange risk. Okay, there are people that want to exchange risk with each other so that each of them is in a better position. So let's look at an example. Let's say that I'm an airliner, right? And I'm a corporation. Corporations don't like a lot of risk. They don't like uncertainty. They want to know how much money's coming so they can go ahead and make plans for that. They want to know how much the expenses are going to be. They want to learn that as soon as possible. They don't like surprises. So if I'm an airliner and I know that, next year I'm going to need, 10 million pounds of fuel to run my airplanes, then what I might do is go to the futures market to purchase fuel in the future. And what will happen is that the market will negotiate with me. The market will come to me with a price that is called the futures price, right? And that is the price that I must pay to lock in, my 10 million gallons of barrels of oil, 6 months from now. And that price might vary depending on what where the price of oil is expected to go. If the price of oil is expected to go up, then the futures price might be higher than what they call the spot price. If it's expected to go down, it might be lower, right? But either way, though, when I make that contract, what's happening is that I'm basically making an agreement with someone else that in 6 months I will buy X number of barrels of oil from you, and this is the price. This is the lock-in. So what's happened is I have offloaded some of my risk, right? But remember, risk isn't really created or destroyed a lot of times. It just changes hands. So effectively, with me offloading my risk, someone else is agreeing to assume that risk. So people go to the futures market for different reasons. Some people go to the futures market to get rid of risk. Some people go to the futures market because they want risk. They want to speculate. Well, why would you want risk? Well, the reason you want risk is because there's a universal connection between risk and reward. Infinite more risk, then that means I have a chance to get more reward. Why? Well, because I'm willing to kind of lose it all. Almost like when you had the gold mines and the gold rush, you had people that took risks to go out in the mountains and then their hills and dig, and they knew most people weren't going to get anything, but they did it anyway because they were hoping they could be one of the people who wins. Or I take risk when I buy a lottery ticket. Or also all the little black boys that want to get to the NBA, they're all taking a huge risk because 99% of them never get a chance to play or make money playing basketball, but they're hoping they can be in that last little 0.1%, right? Now the thing about risk, though, is that there's what they call efficient risk, or what you might call a calculated risk, versus what they call inefficient risk, which is just kind of like too much risk, right? So if I want to go and sell drugs and possibly get killed in front of my kids or sent to prison for 80 years, that will be considered to be an inefficient risk. That's not a good calculated risk. However, if I say, I think I'll invest a little money in real estate and make sure I'm well diversified and not take too many chances and research my investments, that will be considered a calculated risk. Calculated risk is good. You're rewarded for calculated risk, but the stock market does not protect stupid people. Now, not to call you stupid if you take a bad risk, but so I don't want to say it like that. Or better yet, we can all be stupid. We've all been stupid. We've all made dumb decisions, right? Like teenagers make dumb decisions. So the market protects you generally if you are making smart decisions, but it does not protect us from our own stupidity. So if I decide I want to go out here and do something crazy with my money, like put all my money in, one little obscure crypto coin, put all my money in Dogecoin, sure, I'm taking a lot of risk. And there is some reward attached to that risk, but for various reasons that we won't go into today, that is not an efficient way for me to explore my interest in Dogecoin. I could still take on that risk. I could still explore my interest in Dogecoin. I would just have to do it in some degree of moderation. So anything that's done out of moderation is typically bad for you anyway, right? Well, even if you talk about I don't know, gambling maybe, or sex, right? Sex is okay, but if it's not done in moderation, then bad things can happen, right? Same thing is true with investing in risk. So that's what a futures market does. Any recommendation on selling calls on EBIX weekly or monthly? Okay, so call options are kind of beyond the scope of this class. We talked about call options and the income from calls last night in Prime class, and you can definitely go to drboyceprime.com to get that recording. However, my thought on EBIX generally is weekly. I think a weekly strategy on EBIX can be beneficial in terms of generating that income. Let's see here. Okay, so I see the question, the other question about selling options. I'm not going to do options today. This is stock market day. But if you log in at drboyceprime.com, you can go in and get all the recordings of all the trainings we did on options. We did a nice hour and a half long session last night on selling options to generate income. So I would encourage you to go take a look at that. Today, I want us to drill into the stock stuff. Okay. All right. Let's see. Do you need a certain amount in your Robinhood account to use margin? I don't think you do. I don't think you need a certain amount. Do you recommend an ETF that tracks the NASDAQ 100? Yeah. Let me see. You know what? I can't name any offhand, but I know that they do exist. Let me see here. Okay, one ETF that might track the NASDAQ. Invesco, INVESCO. If you look up Invesco, I believe their Power Shares ETF might track, or Pro Shares QQQ. But read it, and make sure it tracks the NASDAQ. But I believe that those two might achieve that goal. Yeah, I'm looking at it right now. Yeah. Take a look at those two, QQQ and VGT, and just kind of take a look and see if that fits what you're looking for. Um, My daughter has started to gain interest in stocks. Good. She's in the ninth grade and has been in BMOT since 2019. Okay, good. Very nice. Good for you. Very smart parent. BMOT stands for Black Millionaires of Tomorrow. That's blackmillionairesoftomorrow.com. That's our program for children. Feel free to go take a look at that. She's in the ninth grade. Let's see. At what point should we introduce options to her? I know it can be complex and she's interested in starting a business. Any recommendations on her starting a business? Well, first of all, let me just say, you have no idea you have no idea. You have no idea what you're doing for this child by getting her started with this stuff early. No idea. No idea. Oh my Lord. I'm so happy for you. I'm so happy for your child. Um, so with that said, I'm not gonna sit here and pretend like I know the perfect way to do things. I can only tell you maybe what Alicia and I do with our kids. Kids are funny. You know, kids don't always take an interest in investing in business the way we do because kids don't really pay bills, right? Your interest in making money, the reason you might be here today is because you've had that experience of being broke and trying to pay bills and trying to make a dollar out of 15 cents. A lot of you have. So that kind of spurs on our hunger to look into certain things. And so with kids, I think every child is very different in terms of figuring out what they're interested in at a certain stage in life. So generally what we found is that when our kids got to the point in life where they started needing money for stuff, I saw that as an opportunity. I could have just, pulled out my wallet and just paid the money, but I've just made a rule. My rule was that I don't want you to ever to think that money is free. So when I give you money, you're going to give something to me and your mom. You're going to do something for us. You're going to clean something. You're going to learn something. You're going to help us get something done. And if you want more money, then you're going to have to do more, learn more. And also, Julian Gordon, who's our dean of real estate in the Black Business School, has a great philosophy. He said, I do not pay my daughter to work. He said, I do not pay my daughter for working. He said, because that teaches her that you should trade time for money. And I heard that. He spoke at our All Black National Convention. I said, that is absolutely a brilliant idea because so many of us, how many of us are trained to trade time for money? But think about this. You're trading something of infinite value that you can never replace for just pieces of paper that you can use to just basically pay bills so you can grow old and die at your job, right? So what he does is he doesn't teach his daughter, he doesn't pay his daughter for work. He pays her to learn things, to pick up skill. Because the more skill you have, the higher your human capital value and the more wealth and income you can extract for a given unit of energy, time, or thought, right? In fact, if you get skilled enough, you can get paid money to pretty much just come up with an idea, right? That's beautiful. That means you didn't have to give any time to anything. And I remember hearing about that when I was 23 and I was going to get my PhD, and there was some Negro naysayer who was trying to talk me out of it and tell me it was impossible. And he said there's a guy at Harvard and they just pay him to sit around and think. And I said, really? Wow, that's interesting. He said, do you think you're smart enough to be a person who gets paid to just sit around and think and not do any work, just sit around and think? And honestly, deep down, I was asking myself that question, like, wow, I don't know if I can be, right? But fortunately, I just had the confidence to say, I think I can. I think if I get enough skill, I can get paid for my brain. So here I am, exactly 30 years after that conversation, getting paid for what's in my brain. So with children, I think that introducing them to economics does not have to involve you necessarily always sitting them down and teaching them a formal class. We've got tools for that, right? If you go to financialflashcards.com, we've got a ton of different flashcard sets that cover everything from real estate to credit to entrepreneurship. Even my book, The 10 Commandments of Black Economic Power, we made flashcards to go with that so you can teach specific Black business school concepts to your kids. These are very unique. No, they don't exist anywhere on the planet. If you go to financialworkbooks.com, we have expert created workbooks that cover every grade level to go through, right? So that's all available. But in addition to that, I think that a little bit of creativity around your child's interest might be the best way to introduce them to economics. And so here's one example of how I taught stocks to our middle child. She told me that all her friends wanted to go to Starbucks and buy this thing called a pink drink. Personally, I don't think children should be in Starbucks. I don't think children should be drinking coffee, but that makes me an old man, apparently. Whatever. So we go to Starbucks to get this pink drink. And I did this mainly because, again, as a bonus dad, if you know anything about having a blended family, it takes time to get to know the kids, right? Yeah, and you have to earn their trust. You have to earn their respect. You can't just go in and just command it. And so I said, okay, well, this is my chance to kind of hang out with her, get to know her, and talk to her. So I took her to Starbucks. We got the pink drink, and I said, let me show you something. I said, do you know that we can? I said, who do you think owns Starbucks? And she's like, I don't know. I said, well, you got to think about who owns the business, because that's the person who's making the money. But Starbucks is owned by a lot of people. I said, so it's really what they call a publicly traded company. I said, so for example, do you know that our family, we can actually own a piece of Starbucks in 2 minutes? And she said, well, how can you do that? And I said, well, let me show you. And so I pulled out my app and I found the stock for Starbucks. I bought 10 shares of Starbucks stock. And I said, okay, now our family owns a piece of Starbucks. That means that when they make money, we're making money now. Our income is aligned with their income. And that kind of blew her mind, right? This idea that you can just get on an app and just own a piece of America, a piece of these big companies that you see. And that was our introduction to stock market investing, and she never forgot that. Another guy I know who was a 30-year-old millionaire, he said that his father used to always say to him, every black man who wants to be independent needs to have his own business. And I said, well, did your father have his own business? He said, no. He said he was a truck driver and he worked for somebody else. He said, but he just always say that every black man who wants to be free should have his own business. So when he got to Ohio State, where he went to college, go Buckeyes, that's where I got my doctorate. He basically majored in entrepreneurship because his father told him that every black man, that wants to be free should have his own business. So here's what I find with kids that's really fascinating is that the what and the how are not as important as the why. The why, like why you're doing something, matters more than what you're doing or how you're doing it. If you give them the why and then they ask about the what, I bet you 9 times out of 10, they're going to go find out the how on their own. This is where culture matters so much. In my book, The 10 Commandments of Black Economic Power, I talk extensively about culture because culture shapes your why, and then it determines your what, right? If you have a culture that does not value financial security or good decision-making or delayed gratification, then if somebody says, well, why don't we take this class together? You're going to say, why? I had that problem. I when I was 18 and there was a girl that I liked, real pretty girl. And I said, one day we can go to college together and or whatever. And she was like, why? Like, why would I go to college? I don't like school. Right. And I was like, yeah, but I would go to college. I want to go to college because I think school will help us. Right. But she didn't see it because her culture was different. Her culture was a culture that did not value education. So when I said we should go to school together, she was like, why would I do that? Hey, that's almost like you telling me we should wear a monkey suit to church. I'd be like, why would I do that? Right. So if you give them the why, this is the part you can control. You control the culture in that house. You make the rules. That becomes gospel, at least until that child is about 15 years old. That what you say is gospel. So make those rules. Like, look, financial security is important. Good decision making is important. Being a solid man is important. Being a really solid woman is very important. Right. All these things. Right. And then the kids, when you come along and you talk about, the things that they might do with their life. You won't have to explain to them why financial security matters, why economic education is important. In terms of something like stock options, I think you can introduce a child to options as a baby if you want. Because think about this. They know what options look like, right? They know what they know. Like if you say, you got 2 options, you can have ice cream or cake. They know what that means, right? Or if you say, well, we took your 2 options off the table, you now can't choose ice cream or cake. You got to eat celery or carrots. They're going to be disappointed in many cases because they're going to say, well, those options are not as good as the others. So they know what options are. So I think maybe talking about options just from a general life standpoint, because this is the secret about wealth and investing in money that I don't know if everybody gets it yet, but I want you all to get this. Is that most of the concepts I could talk to you about in finance are things that you already know. These are already things that you've known because you have this thing called common sense. And so when I talk about, for example, if I talk about diversification, you know what that is. That just means don't put all your eggs in one basket. Your grandma told you that when you were 4. right? But when we talk about risk, what it means to take a risk or high or the risk reward trade off, you know what that means because you've heard people say stuff like nothing ventured, nothing gained, or scared money don't make money. Anybody ever heard somebody say that? Scared money don't make money. That's the risk reward trade off. That's what that is. And I could keep going on and on and on. So effectively, I would say if I'm introducing my child to options, I start by talking about what it means to just have an option. And then at some point, and who knows, maybe in the Black Business School, we can come up with some sort of stock options program for kids or something like that. That's something to consider. I would also introduce it in terms of understanding the buy side and the sell side. I separated the two in our training because I found that it's kind of hard to understand it all at the same time because it achieves different goals. So on the buy side of stock options, you're typically talking about speculation, people that are trying to buy a chance to own a piece of a stock without putting up all the money, right? And what they do is they take on additional risk in exchange for paying a lower price point. In a way, it almost reminds me of like the people that rode on the Titanic across the ocean. Leonardo DiCaprio in his movie, he rode in the bottom of the boat with poor people because they paid less, but they took a bigger risk because they had to be at the bottom of the boat and they didn't have lifeboats and all that, right? So to some extent, buying an option kind of does that. You take on added risk in exchange for not having to put up as much money. So if that stock does take off, then you're on board. You get a piece of that. But if that stock sinks like the Titanic, they're going to save you last. You lose your money first, and then the investors, are going to lose money too, but they still have some ownership in the company. On the sell side, though, you're selling the risk, right? So selling the risk is a different thought process from buying the risk. So selling stock options might be done by somebody who is looking to generate extra income by selling some of their upside, right? So in a way, it's almost like if you're on the Titanic and you have wealthy people. So let's say you have poor people that want to buy options, right? So they're willing to take on the extra risk to pay a little bit less. They'll ride in the basement of the boat or whatever. So let's say you're rich and you own half the boat. So you say, well, I'm rich, but I need income. So I'll sell the seats that I don't really want anyway. I'll sell the basement area to the people that want to get on the boat and take a chance. Right. So that in a way, that's kind of what actually happens. So the people that tend to sell the options are people that aren't looking for extra risk or extra adventure. Remember Leonardo DiCaprio, when he got on that boat, that's what he was talking about. Him and his buddy Fabrizio, whatever it was. He was like, yeah, we're going to have all these adventures. Right. Well, rich people, they're not into taking on additional risk. Typically, they're trying to minimize their risk, right? It's like the difference between a basketball player or a team that's 20 points behind that's trying to get back in the game. They're going to take a lot of three-pointers. They're going to move the ball down the court. They're going to take a lot of chances. But the team that's 20 points ahead is not going to do that. They're going to slow the game down. They're going to be very conservative. Or in football, the team that's losing by 3 touchdowns is going to throw the ball on every play and do onside kicks. The team that's up by 3 touchdowns is going to run the ball. They're going to be really careful, right? So it would tend to be somebody who is simply trying to generate income from their pre-existing investments in many cases, particularly in the case of covered calls. The person trying to buy options is the person that's taking on that extra risk, hoping for a quick come up, but they're willing to lose it all if things don't work out. Okay. So anyway, that's the long answer to your question. The short answer is good job with your daughter. Keep talking to her about money, keep talking to her about life. And then as she gets older, you'll find that the conversations with children tend to change based on the age they're at. And there's a phenomenal shift that occurs when the kid hits college, because that's their first introduction to the real world. And that's when they're going to really need you more than ever. And they're going to come home wanting to talk to you about things that they never wanted to talk about before. That's the most fun I've had with my kids, is talking to them once they got to college, because then we got to talk about real life stuff. All right. Let's see. Are you buying puts and selling calls to cover your position when selling calls? Are you buying puts and selling puts? Oh, you're buying puts. You buy puts to protect your position. Hey, Doc, can I do the $5 day on the ETF on Robinhood? Yes, you can, Preston. Yes, you can. And Shauna's in the chat. She can share with you the link to the $5 a day plan. Also, my website, boycewatkins.com. It's up there. Also, if you're looking to look for some basics on economics and investing and all that, blackmoney101.com is a place where you can go as well if you want to take a look at that. Just anything that might help your family get to where you want to get to. Okay, so give me 1 second here. I'm going to one thing that was on my mind too. Did anybody follow this drama with Microsoft and what was happening there? It was crazy, right? In case you don't know, here's what happened. Basically, Sam Altman, who is one of the most visible faces on the planet as it pertains to AI, he was let go of by the board of the company OpenAI, and so they fired him out of the blue. Everybody was shocked by this, and then when they fired him, Microsoft then hired him. So he got fired. Greg Brockman, another person who's critical in the creation of AI, he quits out of protest. Then Microsoft hires Greg and Sam, and then the employees at OpenAI write an open letter saying that they're all going to quit if the board does not resign immediately. So more than 2/3, actually, out of 750 employees, 677 of them signed this letter saying we're all going to quit, a mass exodus, if the whole board does not resign. And so one of the board members reversed his position. His name was Ilya, Ilya. I don't have his last name. He reversed his position. He surrendered. He threw out the white flag. He said, "I'm sorry. I didn't mean to do it. I take it back. I want him to come back." And so now it's sort of this interesting issue of what they refer to as corporate governance. It's fascinating because I've never seen it happen before. It's also interesting because AI is one of the most critical areas of investment right now. It's one of the most interesting areas out there. In fact, I think you should be invested in some of these companies that are going to make all their money in AI. Some of them, you're going to have some multi-trillion-dollar companies come out of this. If you want to get a list of my AI stocks, if you haven't done this yet, make sure you text the word stock, STOCK, text stock to 31996. If you text stock to 31996, I can send you that list and the $5 a day plan, all that stuff. But anyway, so the governance issue is intriguing because basically the way corporations are structured is that you have the CEO. The CEO is not the boss. The CEO is hired by the boss. Well, who's the boss of a publicly traded company? Well, it's typically it's the shareholders. Now, OpenAI, though, is not a publicly traded company per se, right? It's got a nonprofit entity arm that controls the for-profit arm of the company. It's really crazy. So this thing is now worth like 80-90 billion dollars because they're literally making, their revenue just shot up probably 100,000% or something in a year because of ChatGPT. And so there's this interesting thing. Typically in a corporation, the shareholders own the company for the most part. The board of directors are like congressmen. They're elected by the shareholders to represent the shareholder interest and to hold the managers accountable. So the CEO can't just do whatever they want. The CEO, if they get out of pocket or if they don't perform, they will be fired. The board will vote to remove that person. The board will be acting on behalf of the shareholders. So sometimes you have these fights. They might call them proxy fights. Disney was having one recently where you had a person who felt that the CEO, Bob Iger, was driving the company off a cliff, and he demanded a board seat to help fix this. And they feel that Disney's making some critical investing mistakes. Like one of the mistakes they're making, one of the weird things they're doing right now that doesn't make sense is ESPN. They're promoting gambling through ESPN. And that doesn't make sense because Disney's supposed to be a family company. Gambling addictions are the quickest way on earth to destroy families. I mean, literally, it's destroyed. I wrote that book, Financial Lovemaking, years ago. And I remember learning from that book how horrible a gambling addiction can be for a family. So if you have that issue in your family or with your potential partner, address that, please. Because what gambling does, and I'm going to get back to OpenAI, but what gambling does is it puts you in such a financial sinkhole that your job can't get you out of that sinkhole, right? Think about this. I've seen so many examples of a guy who gambles a lot, who makes $40,000 a year, but he's like $90,000, $100,000 in debt. Well, a $40,000 a year job will not get you out of $90,000, $100,000 of debt. It's not Possible in most cases, maybe 30 years later, 40 years later, but seriously, who wants to do that? So the only way you can get out of a debt that big is to continue to do the thing that created the debt in the first place. That creates that gambler's debt spiral, right? Think about it. The only way you can make back the 100 grand is to go gamble big and to gamble bigger, hoping that you can win back your losses. So it is that desire to win those losses back that causes the gambler to go deeper and deeper and deeper and deeper in debt. Next thing you know, you got somebody that done jumped off a cliff or shot himself or whatever because he's so embarrassed about what he did to his family and the finances. And in many cases, the family is not communicating. The spouse has no idea this is happening. So I just want to really implore you, please be mindful of gambling and gambling addictions. I know a lot of people play, they do their little thing, and I'm not judging at all. I would just say, just because it's legal doesn't make it okay. This is the next epidemic, by the way. They're creating the next epidemic. Capitalism does it. Capitalism creates public policy nightmares, just like they did with the opioid crisis. Okay, we can make money by selling these drugs that are really addictive. That means we're going to have a great customer base. And as long as we find some way to justify it, because the FDA will let us do pretty much whatever we want because we own the politicians. Next thing you know, you got the opioid crisis. Same thing, handguns. Well, selling guns is really profitable, especially if we sell them illegally. So we're going to just flood the market with guns because capitalism is built on growth. And the more guns we sell, the more guns we need to sell, which is why you got more guns in America than people. Shout out to Louis Farrakhan. I had my conversation with the minister was when he actually brought that point to my attention, and I thought about that ever since. By the way, talking to him for 2 hours alone was probably the most interesting experience in my life. I just have so much respect for that man. Just have to say that. But with that being said, let's get back to OpenAI and what happens with OpenAI. So OpenAI, they have an odd governance structure, and the Microsoft CEO has spoken on this. He said their governance needs to change, but they've got this nonprofit entity, which is good though, to a point, because AI is so dangerous. Their logic is we need some people who are not motivated by money to manage what AI can do so that we can sort of deal with these problems before they get too big. But the downside of that, though, is you get these awkward decision-making processes where you're getting rid of Sam Altman, who is literally the multi-billion-dollar asset. He's the Steve Jobs of one of the biggest technology movements in the last 50 years. You don't fire him. That's crazy. Remember, when Apple fired Steve Jobs, they paid a price for that. They lost tens of billions of dollars in value because the company just didn't run the same when he was gone. So basically what's happened now, where it stands now, is they've actually invited those guys back to join the board. But I think that what's going to occur is you're going to end up seeing that board dismantle itself. I think that they're going to just become a Microsoft entity for the most part. And this is going to just be, the subject of a Netflix movie or something. It was that interesting. And I think it's also interesting to observe and watch people's behavior, because here's another thing. This actually relates to stuff I've written about in my book that I was telling you guys about. The CEO of Microsoft, Patella, I can't remember his whole name. Forgive me. Maybe that makes me a bad person because his name is Indian and I should be able to pronounce it, but I just can't. I don't have it in my head. But anyway, Patella basically, he understands something. He makes $57 million a year, and they pay him $57 million, and he's worth every penny. And the reason they pay him that money is because he understands something important that I wrote to you guys about in my book, which is that drama loses money. And so Microsoft's goal from Jump Street was to squash the drama. They said, we got to squash this now, because if we don't, then on Monday morning, our stock price is going to crater, because the market doesn't like drama. Stock prices don't like anything that appears to be volatility, right? So like Keke Palmer, the actress, I don't know if y'all follow this stuff. My wife does, because she's she's a relationship therapist, and as well as just a psychologist, and she does things like financial anxiety and all that. If you've been following Keke Palmer, the actress, she's in the middle of this crazy domestic violence thing, and nobody knows who did what, and it's just kind of a big mess. Well, if Kiki's career was a stock, the price might have dropped, because there might be people who say we don't want to deal with that kind of drama. Or Diddy and his ex-girlfriend, they had the big lawsuit and the big drama. Well, if Diddy was a stock, his stock has probably dropped, right? Because basically, from a pure mathematical standpoint, when you value a stock, you put risk and drama in the equation. That's part of the equation. So when drama goes high, prices go low. So for example, if tomorrow we announce that Chinese warships were pulling up on San Francisco harbor or something, and that the Chinese were about to go to war with the United States, well, then you would see the markets completely collapse, because that would be like, oh my God, drama is building up. Valuations cannot really withstand that type of pressure. Okay. So Microsoft is a smart company. I think they're going to handle it properly. I encourage you to pay attention, because it's a good lesson on corporate governance, and also how these sort of capitalist incentives get sort of mangled and confused in the face of something like AI. Now, by the way, some of you are asking what was the stock I mentioned earlier. It's SVV, Sierra Victor Victor. That's Savers Value Village. So that's the stock that I mentioned earlier. Let's see. I know I'm dumb about ETFs. You're not dumb, Preston. I have to pay a fee to do this? There might be a small fee that you pay to make a trade, but it's not very much. So I think ETFs, I think that they're worth the fee. I think it's worth the investment. Okay, so we I'm going to go ahead and bounce out today. We've done an hour of conversation. I hope this conversation has been helpful. I don't want to overwhelm you with just too much stuff. I want to come in and say hi, answer your questions, talk to you about some stuff. Also, if you text the word stock to 31996, if you haven't done that yet, text stock to 31996, and I'll be able to notify you when we're doing things like this. Also, if you go to drboycebooks.com, you can get copies of my books, my wife's books, etc. And of course, a lot of things are discounted because it's Black Friday and all that stuff. So feel free to go take a look at that. Our financial flashcards for kids are there, as well as our workbooks for kids. So feel free to go take a look at all that stuff. And also, for those of you that are interested in seeing what we do in the Prime program in terms of generating income by selling stock options, just go to drboyceprime.com. I think you're going to like what you see. All right, guys, I'm out.